Good morning, everyone. Whether you're heading out to work, getting the kids ready for school, or just starting your day, there's one thing on everyone's mind: money. How much we earn, how far it goes, and what the future holds for our pay packets are questions that touch every household in the UK. Today, we're diving into a crucial topic: our money and jobs. The pay we take home isn't just a number on a payslip. It shapes our choices, our security, and our dreams for the future. After a period of rapid pay growth, the UK is experiencing a slowdown. For a while, wages were rising quickly, helping many people keep up with the cost of living. But now, that pace is easing off, and it's making headlines across the country. This isn't just a headline, it's a real change affecting families, businesses, and the country as a whole. For parents trying to stretch their paychecks, for small business owners balancing their books, and for young people entering the workforce, these shifts are deeply personal. Wage growth is easing, like a car gently slowing on the motorway. It's not a sudden stop, but a gradual reduction in speed. This means pay rises are becoming less frequent and less generous than before. This signals a cooling job market, with companies less eager to hire or offer big pay raises. Job adverts are fewer, and employers are thinking twice before increasing salaries. For many, this means tougher competition for new roles and fewer opportunities to negotiate better pay. For job seekers, it can feel like doors are closing just as they're ready to step through. And for those already in work, the hope of a significant pay bump may be fading, at least for now. It's a complex puzzle involving job availability, economic health, and the delicate balance between what businesses can afford and what workers need. Economists are piecing together data from across the country to understand what's really happening beneath the surface. We'll explore the numbers economists watch, like wage growth rates, inflation, and employment figures, to get a clearer picture of the trends shaping our pay. And we'll look at the Bank of England's role in all this. Their decisions on interest rates can influence everything from mortgage payments to the cost of borrowing for businesses, which in turn affects how much companies can afford to pay their staff. Most importantly, we'll connect these economic ideas to your everyday life. When pay growth slows, it can mean making tougher choices about spending, saving, and planning for the future. Economics isn't just about charts. It's about people and their financial security. It's about the anxiety of opening a bill, the relief of a pay rise, and the hope that things will get better. Understanding this helps you plan for the future and feel secure. By knowing what's happening with pay, you can make informed decisions, whether it's about changing jobs, asking for a raise, or adjusting your budget. Let's unpack this story and see what it means for you. We'll break down the facts, hear from experts, and share real stories from people across the UK. Because at the end of the day, it's about your ability to plan for the future, pay your bills, and feel secure. Let's get started and find out what's really happening with UK pay. Wage growth is the rate at which pay increases over time. It's crucial because it shows if earnings keep up with living costs. Healthy wage growth boosts spending, benefiting businesses and the economy. Weak growth leads to less spending and a slowing economy. The Bank of England focuses on private sector pay as an economic indicator. Slowing wage growth signals easing competitive pressure in the job market. This helps control inflation, a key concern for economic managers. It's a delicate balance, and the scales are tipping. Let's take a deeper dive into the current state of the UK labor market, a topic that's on the minds of workers, employers, and policymakers alike. The landscape is shifting, and understanding these changes is crucial for anyone navigating the world of work today. We'll examine the latest data released in November 2025, which paints a complex picture of employment, wages, and business sentiment across the country. One of the most notable trends is that wage growth has slowed to 4.6% in the 3 months leading up to September. While this figure might still seem robust compared to pre-pandemic years, it actually represents a significant cooling from the rapid pay increases seen during the economic recovery. This deceleration in wage growth is part of a broader trend, as the UK economy continues to cool after the post-pandemic surge. Many businesses are now facing a more uncertain outlook, with slower demand and tighter budgets. In fact, private sector pay growth is now at its weakest point since early 2021. This is a clear signal that the days of rapid wage hikes may be behind us, at least for the time being. With less competition for talent, businesses are feeling less pressure to offer high salaries or generous benefits to attract new employees. Many are instead focusing on cost control and efficiency. unemployment has also risen, reaching 5%, the highest level the UK has seen in over 4 years. This uptick means more people are actively looking for work, increasing competition for available jobs. As more job seekers enter the market, employers have a larger pool of candidates to choose from. This shift reduces the urgency to raise wages, as filling vacancies becomes easier. Another concerning sign is the drop in payroll numbers, which fell by 32,000 in October alone. This is not just a minor fluctuation, but a significant decline that points to deeper issues in the job market. It's clear that this isn't simply a slowdown in hiring. Some companies are actively reducing staff, either through layoffs or by not replacing departing employees. The overall labor market is weakening, with fewer job openings and more people searching for work. This environment is putting downward pressure on pay growth and making it harder for job seekers to find new opportunities. All these factors together signal a clear shift in the UK's economic conditions. As the labor market softens, both workers and employers will need to adapt to a new reality, one where job security and wage growth can no longer be taken for granted. Numbers can be confusing, so let's add context. When we look at economic data, it's easy to get lost in the percentages and charts. But behind every number, there's a story about people, businesses, and the choices they make. Understanding these trends helps us see the bigger picture of what's really happening in the UK economy. For example, a 4.6% wage growth might sound impressive at first glance. Historically, that's a strong figure, suggesting that workers are earning more than in previous years. But the real insight comes from looking at the direction of the trend, not just the number itself. Is wage growth accelerating, or is it starting to slow down? Recently, we've seen consistent declines in wage growth, which is a clear sign that the labor market is cooling off. Fewer job openings and more cautious hiring mean that companies aren't competing as fiercely for talent as they were before. This shift can be unsettling for workers, as it often leads to fewer opportunities and more job insecurity. Back in 2024, the UK faced a cost of living crisis that pushed wages up rapidly. Families struggled to keep up with rising prices for essentials like food, energy, and housing. In response, many employers felt pressure to offer bigger raises just to help their staff cope with everyday expenses. Now, with inflation finally coming down, that pressure has eased. Companies are no longer forced to increase pay at the same pace, which helps them manage costs and plan for the future. This shift is good news for business stability, but it also means workers may see smaller raises than before. At the same time, unemployment has risen to 5%. This change shifts the balance of power in the job market. When more people are looking for work, employers have more choices and can be more selective about who they hire and how much they offer. Previously, when unemployment was low, workers had the upper hand. They could negotiate for better pay and benefits, knowing that companies needed them. That leverage is now fading as the job market becomes more competitive. With more candidates available, employers can take their time to find the right fit. This abundance of talent means they don't have to offer as many incentives to attract new hires, which further slows wage growth. The Bank of England is watching these trends closely. Their policies are designed to slow the economy just enough to bring inflation under control, without causing unnecessary harm to businesses or workers. The cooling labor market is a sign that their strategy is working. Fewer job openings and slower wage growth help keep inflation in check, which is essential for long-term prosperity. While these changes can be difficult in the short term, they're a necessary step toward building a more stable and resilient economy for everyone. For some, this transition is painful: job losses, tighter budgets, and uncertainty about the future. But these adjustments are crucial if we want to avoid bigger problems down the road, like runaway inflation or economic instability. Ultimately, the Bank of England's approach is about finding the right balance, protecting the economy today while laying the groundwork for a sustainable and prosperous future for the UK. The Bank of England is the UK's economic guardian. Its main job is to keep inflation low and stable at 2%. The bank rate influences borrowing costs across the financial system. Raising rates makes borrowing expensive, encouraging saving over spending. This strategy fights high inflation by reducing demand. Now, with a slowing economy, the bank faces a decision. Keeping rates high risks a recession. Lowering them could boost growth. The Monetary Policy Committee regularly reviews data to decide on rates. Their decisions impact mortgages, loans, and the broader economy. Wages, jobs, and interest rates are interconnected. Rapid wage growth can drive inflation, leading to a wage price spiral. Slowing wage growth eases inflationary pressure, aiding the bank's goals. Rising unemployment confirms a softening job market. This reduces pressure on employers to offer high pay. The bank's interest rate hikes are working, slowing the economy. The big question: will the bank cut rates to boost growth? A rate cut would lower borrowing costs, encouraging spending. Investors anticipate a rate cut soon, possibly before Christmas. What does this mean for you and your family? Slowing wage growth affects personal finances and job security. Companies may offer smaller raises, so budgeting is crucial. Rising unemployment makes job hunting more competitive. However, a potential rate cut could lower borrowing costs. Cheaper mortgages and loans would ease financial pressure. This encourages spending and investment, boosting the economy. It's a trade-off: weaker job market for lower borrowing costs. Let's explore real-life examples. A coffee shop owner sees stabilizing costs and more job applicants. A young couple hopes for lower mortgage rates to buy a home. A factory manager considers new machinery with cheaper loans. Grocery bills stabilize as wage pressures ease. These examples show the cooling labor market's impact. Businesses feel less pressure to raise prices. Lower interest rates make borrowing more affordable. This encourages spending and investment, supporting growth. The economy's cooling phase offers opportunities and challenges. Understanding these changes helps navigate financial decisions. It's about adapting to a shifting economic landscape. These labor market changes signal a major economic shift. Slowing wage growth and rising unemployment mark a transition. The challenge: a tougher job market and smaller pay rises. The opportunity: potential interest rate cuts easing financial pressure. Lower borrowing costs benefit households and businesses. The economy's rebalancing act is underway. Higher rates curbed inflation. Now recovery begins. This phase brings unique challenges and promises stability. Understanding wages, jobs, and rates helps navigate changes. It's about making informed decisions for a secure future.